facilitated acquisition of Bear Stearns by J.P. Morgan back in March. After Lehman Brothers failed in September, we saw a huge decline in confidence in the banking and financial system, and the Fed decided to raise the FDIC deposit insurance from $100,000 to $250,000 temporarily. The Fed raised the deposit insurance to try to prevent a run on deposits and bring back some confidence to the banking system. Another thing that the Fed did was sign the $700 billion economic stabilization package. This package had the intention of purchasing some of these illiquid assets from the banks that were holding them on their balance sheets to put them in a better financial standing and improve their liquidity. This should not be considered as a bailout or a donation to these banks, because the Fed can and probably will make some money off of these assets.
So the Federal Reserve faces the dilemma. While inflation is always a concern for them, we believe that economic growth should be their main focus for leading today's economy. While the CPI total is a bit troubling, it can be explained by the unusually high cost of oil. Oil prices are receding, which should help to curb this high total CPI number. Growth is an important target now because of the various factors explained by my partners. GDP seems to be slowing down, unemployment is on the rise, consumer confidence is weak, and consumer spending is negative. Next slide, please. The intended federal funds rate is the rate that private institutions lend money to each other within the Fed. The Federal Reserve sets a target rate for these transactions, which helps regulate the flow of money within the economy. The target's funds rate has been lowered at the past 2 consecutive meetings of the Federal Open Market Committee. On October 29th of this year, the Fed brought the rate down by 50 basis points, or 0.5%, to 1%. This is a historically low number and hasn't been seen since 2003. And the most recent drop of this federal funds rate has bolstered the U.S. stock indexes, such as the Dow and the NASDAQ. And while both remain somewhat volatile, they are on the rise. Next slide, please. So you can see from this graph, we have the target federal funds rate and the average effective funds rate. And we used weekly averages because weekly averages provide more useful data than the day-to-day, because day-to-day lending between banks can vary so tremendously. And for 2 weeks, as you can see, leading up to the October 29th lowering of the target rate, the actual rate of average was lower than 1% for 2 weeks. And this gives reason for the Fed not to cut the rates anymore, because there seems to be a surplus of loanable reserves. Next slide, please. So the conclusion. Given that the target federal funds rate is an all-time low and operates with a lag, we believe that it is a good idea to keep the target rate stable for now until the full effects of the cuts can be seen. This will also give the Fed leeway in the future if they see that it becomes necessary to lower the target rate any further. Already lowered rates coupled with the Fed's other unprecedented actions should be given time now before more measures are taken. And it is for these reasons that we believe that the Fed should keep the target federal funds rate at 1% and let the Fed's previous actions take effect.
That's it.
Okay, thank you very much.
Thanks, guys. Let me start with asking some questions about you, sort of what you ended with here, some of the Fed's other actions. There are some other, you mentioned a couple of things that in addition to interest rate policy, but there are a number of things the Fed's done with its own balance sheet, another bunch of credit facilities. And I'd like to hear you, if you can, talk about at least one of those in some detail, and more importantly, describe what their economic impact is likely to be both in the near term and over time.
One thing that the Fed has done is they've started buying up a lot of corporate commercial paper, short-term debt, these corporations, they can't get the leverage that they need from the banks anymore. So the Fed's helping them out with that by buying the debt from them, and most of that is short-term commercial paper, which means it will expire within the next 6 months or so, by early 2009.
Over the last few years, do you think that the communication from the Fed has become more or less transparent? And possibly you could cite an example or two to back up your argument.
Can you ask the question again?
Yes, we're all concerned with the transparency of Fed's policy and their intended future plans. Do you believe that the Fed, in communicating with us, now citizens, has become more or less transparent in the last few years?
I think people have always seen the Fed as not necessarily in secrecy, but not transparent, if you will, because they don't understand numbers and rates and such. And I think lately it's become more transparent because the Reserve's actions, such as the bailouts, have been in the news so much and are easier for people to understand, I believe, than numbers and the graphs such as GDP and CPI.
Okay.
I want to ask you a question getting back to one of the reasons you came to the conclusion of holding was that the effective federal funds rate was below target. Can you tell me something about what's causing that to happen? I mean, if you listen to the news, you get the impression that there's no credit out there, which would imply there's no lending, and we know that lending can happen if there are reserves out there, if there are sufficient reserves in the system. I was wondering if you could reconcile those things.
Well, I think that the reserves are out there, but I think banks are just becoming more weary of giving credit to people after seeing the failures of banks such as Bear Stearns.
I believe you introduced your committee meeting with the idea that inflation and growth, that there was a trade-off between the two. I wonder if you could clarify that for me a little bit more.
See, although inflation is relatively high at 4.9%, and that did produce a lot of media and talk about how that was relatively high from what we're used to. But we believe that it's not as big as an issue as people thought or think currently because, or total CPI, because it includes the prices of oil, and because it peaked in 2008 and mainly it peaked in July, we believe that it just exaggerates the number, and we concluded that inflation isn't as big of an issue as